Hello, and welcome to another edition of Beaver Finance. I'm your host, Robert T. Anderson. In this series, we're going to talk about paying off debt versus investing. So if you're new here, welcome. And if you haven't already, please consider subscribing to our channel so that you'll be notified on future videos. So in this video, we're here to talk to you about the top 5 practical ways you can compare if you should pay off debt or if you should invest your money. Now, the answer might surprise you, so you won't want to miss this one. So first, let's look at a few assumptions, because to jump right into this topic, it is a little controversial. So we want to make sure we're all on the same page. So a few assumptions I've made here is you'll already have your emergency fund set up. Now, typically we like to see 3 to 6 months of expenses put away. If you want to learn more about emergency funds, we do have 2 other videos on our YouTube channel, both how to save and maximize your emergency fund, and also how to structure your emergency fund. So you can check those out after this video. As well, we're going to assume that you're already making at least the minimum payments on your debts. So with those assumptions already taken into consideration, let's jump into the video. So, top 5 ways to compare paying off debt versus investing. So first, you want to conduct a budget and a net worth statement. So this is important because 1, you need to know all your different assets and your liabilities, as well as getting a sense of what those are in terms of what assets they are, whether that's a home, an investment portfolio, what are the historical returns, starting to take a look at what are the probable returns in the future. And then on the liability side is understanding what debts those are. Is it a mortgage? Is it a car loan? Is it a student loan? Is it a line of credit? Is it a credit card? Putting in the interest rate, the minimum payment, and also understanding what the term is. So once you compile both the net worth statement that lists all your assets and liabilities, then the budget. You want to make sure you know all your income coming in, all your expenses going out, what those numbers are for each asset, for each expense, and for each liability. And then hopefully you have a surplus, which is why you're considering, do I pay off debt or do I invest? So once you've done that, then we can start to compare interest rates versus returns. So this is hard because typically we know what your interest rate is moving forward, especially if it's a fixed interest rate, then that interest rate will remain constant moving forward for the remainder of the term. However, if it's a variable interest rate, that interest rate is subject to the change in the prime lending rate, at least in Canada. So if that rate goes up or down, your variable rate could go up or down. Now, presently in 2020, those rates are very low. So if anything, we're more likely to see an up than a down in terms of interest rates. Whether that's, in the next 12 to 24 months or longer, more likely longer, that's yet to be seen. So interest rates are much simpler to predict moving forward, or at least have a good idea of what it'll be. Now, rates of return on investments, that can change on a dime. If you were watching this video in February of 2020, for example, you could have guessed in a 6-month period, your investments may, have been up 6, 7, 8, 9, 10%. However, depending on when that was, we saw a big market crash, of course. So on a short-term basis, it's hard to predict what a potential rate of return could be. So there is obviously risk associated with investing. That's obvious. However, if we looked on an annual basis for 2020, most portfolios were up. At least indexes were, and most active funds were as well. So that is something positive, of course. Will that happen again in 2021? We don't know. But if we're thinking long term, 10 years or longer, rates of return historically have been positive. So we definitely, want to base a return. You can look at the indexes to come up with your assumption. So I won't give you one, but you can look up, for example, S&P returns, a Dow. I wouldn't use a NASDAQ, only because, it's high concentration in tech. If anything you're going to invest, you're going to build a diversified portfolio. So looking at rates of return, you can use some assumptions in terms of the indexes. So next, we want to compare how much time you have. So where I was talking about short-term versus long-term, if you only have a short-term window, certainly that favors paying down debt. Of course, in the long term, investments will do better in terms of the return on that money. However, if it is short term, I'm going to give the point to debt. So comparing time is something you need to factor in when comparing paying down debt versus investing. So next, you want to compare the long-term benefits of investing versus paying down debt. So for example, if putting extra money towards debt will make you debt-free 1 year sooner, but that prevents you from putting that money towards investing, you'll be surprised what that 1 year can do if you have a long time ahead of you. So what do I mean by that? Well, that if we're talking about $1,000 towards debt will make that difference versus $1,000 investing, that $1,000 in 10 or 30 years or even 40 years will be worth a lot more. So short-term pain to have debt for an extra year, knowing that long-term you're going to have that many thousands of dollars more investing, might be worth the delay or staying on your original debt schedule. So, we always hear, my debt's 5% or it's 6% or it's 7%. You want to pay that down right away before you start investing. But you have to think about it in a long-term perspective. So, in the short term, can you match a rate of return to the interest rate of that debt? Probably. That's very realistic. Is it guaranteed? No. So that's the risk you take in the short term. Now, like I said, in the long term, you look at what will that $1,000 turn into. So think about that when comparing the two. So future value is very important here. Now, if we're talking a lot of debt, obviously, coming up with a debt management strategy is going to be paramount. Investing is probably not even in the cards. But if we're talking, surplus money that you're looking to compare, paying down extra debt payments versus extra investing, well, it makes a big difference. So I would give the benefit here to investing. So next, you really want to consider comparing the available tax deductions to you. So depending if you live in Canada or the US or in another country, Each country typically has registered accounts for investing. So these would be accounts that you either contribute to pre-tax or after tax. So either you get a tax deduction for contributing to the account. So in Canada, that's an RSP. We get a tax deduction. Or accounts that you contribute to after tax, like a tax-free savings account in Canada. In the US, I believe it's 401k and Roth IRA or IRA. So you really want to take a look at those accounts, because if you are going to invest and say you have that $1,000 to put towards either debt or investments, depending on your tax rate, if you have available room in your RSP or potentially 401k, and you can get a tax deduction of 20, 30, 40 plus percent, that percentage is a lot higher than the interest rate on your debt. So here, it could even open the door to do both. So what do I mean by that? Well, that $1,000 could be put into that that account to get a tax deduction. That $1,000 would then get you $300 back if it was 30% tax deduction. If it was 40, you could get $400 back. So now you've got $1,000 invested, and you're expecting a tax return of $300 to $400. So that $300 or $400 you could potentially take and put it on your debt. So that's probably the best of both worlds. Sure, you're not putting $1,000 on your debt, but you're maximizing what little resources you have right now. So I really have to give the points here to the investment side. That $1,000 all of a sudden is now $1,300 or $1,400 in those examples I used. So obviously, speak to an accountant on this, your advisor. However, do the math. It's quite obvious which one wins out here. So comparing and looking at available tax deductions can really help sway you to pay down debt or invest. So if you've watched any of our previous videos, you know we like to include a lot of bonus content. So our bonus tip would be, and the last tip we gave was a good segue, is what if you could do both? So what if you could invest and pay off debt at the same time? So perhaps right off the bat, if we keep on that $1,000 example that I've been using, what if you just did 500? Well, that might be the right answer for you. It's a balanced approach. You're achieving both objectives. Sure, your situation might work out better with a few of our other tips in terms of which answer mathematically would work out better in the short and the long term. However, it may just be more of a peace of mind knowing that you're doing both, in terms of the human psychology around paying off debt and investing. So doing both could just be simply splitting it. Or you could do other variations, right? 60-40, 80-20. You could do both that way. Now, the other way to do both, and I'd mentioned this in the last tip, was tax deductions. So looking at maximizing your resources. Now, there could be other ways for you to get tax deductions. You might already receive some tax deductions or tax credits, depending on where you live. Certainly looking at maximizing your tax return. It's very timely this time of year. You'll be filing soon. Any tax return you do get, you can put that towards debt or investing, and use some of these tips to consider when you're doing your assessment of which situation will work best for you. So if you've missed any of our previous videos, please be sure to check those out next. Now, our question of the day. Let us know below if you've been faced with the dilemma of debt versus investing. Let us know what you did, or let us know what you're considering doing if you haven't done it already. Or if you've got any extra tips to add, please let us know. So if you got some value from this video, please hit the like button and don't forget to subscribe. It means a lot to us, and this way you'll be notified on future videos. So thanks for watching this video, and we'll catch you in the next episode.